Crypto's crashed, the stock market is crashing, housing will be next. I'm Biko Konstantinos, and that's what we're going to talk about today. I'm here to serve you through quality, independent, and up-to-date market analysis and education. So why don't you crack this video a like and consider subscribing to my channel? I would love to have you on board. Together, we can help each other navigate these very volatile times. Now let's see why the housing market could be the next in line to crash big time. What I like to call the everything bubble hit a crescendo in late 2021. It's as if all the crazy speculation gathered momentum for one final push. But as with all speculative bubbles, it has to end. Bubbles normally work on the greater fool theory. It can always keep going up as long as there's another fool to pay more. When you run out of fools, that's when the bubble bursts. The most crazy speculation was seen in the crypto market, and that was the first to implode. Here we've got Bitcoin making an all-time high in November 2021, but the bubble burst and Bitcoin is now down 67% from its all-time high. Ethereum, the second biggest crypto, is down 75% from its all-time high. So here we've got the two biggest cryptos down 60 and 70%, which is not just a crash, it's absolute destruction. Two more examples of the crazy speculation in the crypto space. Dogecoin, which was heavily hyped, has now fallen 91% from its all-time highs. And Shiba Inu, which was all over the news at one stage, has now fallen 90%. Consider this speculative rise of Shiba Inu in late 2021. The rise seemed to be all based on the price going up and pretty much nothing else. And that was one of the clearest signs that the market in general had reached mass speculation. And when things go up just on speculation, it can't be sustained. On the 9th of November, around this period here, I released this video which said sell SHIB now. Now I'm not a master forecaster, but when you see crazy hype and speculation, you know there could be extreme danger ahead. And sadly, people have lost fortunes from cryptocurrencies collapsing. While cryptocurrencies are considered very speculative, the stock market is invested into by nearly everyone, whether it's personally or through their 401k or superannuations. The S&P 500 is down 21%. The Nasdaq is down 30%. And the Russell 2000 is also down 30%. As you can see with the Russell, it didn't rally as high as the other two major indexes, which highlights to me that it was the bigger corporations and companies that benefited the most from the mass stimulus and ultra cheap money which occurred after COVID. A very important thing to consider with this chart is that the Russell 2000 is now trading at the same level that it was pre-COVID. As we all know, we went on a money printing spree after COVID, but now that the money tap has been turned off, we're starting to see all the indexes fall, and if the Russell falls any further, it will actually be worse than it was before COVID hit. And that would be a very bearish signal in my opinion. These sharp falls has seen trillions wiped off the stock market, and that has to have an effect on the broader economy. We've already seen reports of companies having to lay off staff because the growth is just no longer there. And there's nothing in the stock market charts or the fundamentals for the stock market that leads me to believe that this correction is in any way over. I feel like we're smack bang in a bear market, which could last quite some time. So why is the housing market going to be the next one to crash? Now, since housing rose along with the stock market, along with the crypto bubble, it stands to reason that the factors causing the crash in crypto and the stock market would also potentially cause a crash in housing. So what caused the everything bubble to rise? According to this Axios article, we had radically increased money supply, mortgage forbearance, stimulus checks, low taxes, and ultra low interest rates. Now we've still got some government intervention as they're trying to help people through the high cost of living, but the money supply is drying up as we go from quantitative easing to quantitative tightening. The propping up of the housing market has finished. Stimulus measures can't keep going at the same levels because national debts are getting out of control. And possibly the biggest factor, interest rates are being raised aggressively to try and combat soaring inflation. This can be clearly seen by the latest 75 basis points hike from the US Federal Reserve, which is the largest interest rate hike in a number of decades. So because everything rose at the same time due to a number of these measures, the reversal of these measures, for example, interest rate measures going from ultra low to a lot higher in a short period of time, will have a very large impact on the housing market and may even cause a crash. Check out the chart of the US money supply. After COVID hit, we flooded the market with money and then increased it from there. So this corresponds with the stock market rallying sharply, cryptocurrencies going wildly speculative, we had meme stocks and other things like that go through the roof, and it all came to a crescendo in late 2021 around here. I think it's very significant to realize the parallels between all this new money supply and the everything bubble that we saw after that. According to this article from Livewire, the biggest factors affecting property prices are rates and availability of debt, demand and supply of housing, and population growth from outside the country bringing foreign capital in. Now, because borders were closed during COVID, we didn't have any of that foreign income coming in, but property prices still went on the most unprecedented rally we've ever seen. Now, this article is discussing the Australian property market, but as every country experienced the same rally in house prices, I think it relates to all markets. So the writer states that interest rates and availability of debt, i.e. borrowing ability, is what drives property prices. The article provides this chart which shows how tightly linked the ratio of property price to GDP and credit to GDP. Their conclusion is that the price of housing is not determined by demand and supply of housing, it's driven more by demand and supply of debt. Now this red line here shows the Australian residential land value over GDP, which has basically gone parabolic since COVID. And linked to that is the bank credit over GDP, which is linked so very closely to the land value. So when rates were dropped to near zero after COVID, it created massive demand for cheap debt. For example, mortgage rates in Australia were around 2% or under, which meant you could borrow $1 million and only have to pay about $20,000 of interest per year. Yes, there were plenty of other specific COVID-related factors that helped to increase demand for housing, but extraordinarily cheap debt was one of the biggest in my opinion. So if that's the case, what happens if all the cheap debt vanishes, but even worse, debt for housing starts to become expensive? This is what we're seeing in the US, where the average 30-year mortgage rates have climbed above 6%. Now, once we're seeing 6%, 7% or 8% mortgage rates, debt starts to become expensive. So the demand to get cheap debt to buy property is no longer there. And as a result, house prices fall. So why will house prices fall? Interest rate hikes means borrowing power will be greatly reduced. This will occur for both home buyers and investors. Whereas previously, for example, they might have been able to borrow $1 million. With the current interest rate hikes, they may only be able to borrow $850,000. And if interest rates are hiked more, the amount they can borrow will reduce even further. This could have a dramatic effect on house prices as buyers are just not able to offer as much as they previously were. And due to many more interest rate hikes forecast, many buyers will not be borrowing as much as they possibly can due to the added risk. Mortgage costs are increasing significantly. This could lead to some owners actually defaulting on their mortgage. But even more likely, some investors who have over-leveraged during the recent boom may have to sell one of their investment properties because they can no longer afford to cover all their repayments. And when you have situations when someone's forced to sell but the buyers are offering lower than what the sellers are asking, the price has to actually come down to meet those buyers. investors are becoming a lot more cautious. The whole market has changed to one of crazy speculation to now protection of money. So because of all the risks in the market, it's unlikely that investors will keep paying top dollar for properties. There's been a massive loss of wealth recently with crypto and the stock market crashing. So many people have seen their net worth significantly fall, even if they own some of the top companies in the stock market. So when your net wealth falls, you're less likely to make big investments. You're also more likely to become fearful and take on a wealth protection type attitude. As property prices start falling because of these reasons, the media will have a field day and report it like crazy. And this could just ramp up the fear in the market, which can actually lead to further declines. And on top of all this, it's looking more and more likely that the world might be headed for a global recession. And a recession would mean that companies aren't making as much profit, which then means people get laid off from their jobs, which could then put even more downward pressure on the housing market. We've gone through many reasons why house prices will fall or even crash, but there's many people all over the internet who think there's no chance that housing's gonna fall. And the main reasons that I've read are the following. First, there's not enough inventory, so there's not enough supply or not enough current housing, and it creates extra demand that prices will always keep going up because of that. Now, the difficulty I have with this reasoning is, why did prices suddenly skyrocket directly after COVID, and where we had lockdowns and nearly every country wasn't allowing any immigration? So yes, some areas might have a bit of a shortage, but I don't see why a shortage would have come to every country all at the same time to create a housing boom. Nearly every city and town has a housing plan to cater for their population and any intended population growth. Another reason I hear is that building a new home costs so much. How could house prices actually fall? Yes, building prices has gone up, but I don't think that's going to keep the market from falling. Prices of lumber go up and down, prices of builders can go up and down, and things like that. Because of the materials shortage and the absolute crazy demand we've seen, the prices of new builds did skyrocket. But now that we have mortgages soaring, there might be less and less people deciding to pay the high prices for a new build. The other thing I've heard is that after a year or two of interest rate hikes, the economy will fall into a recession, so central banks will actually have to reduce interest rates again, and that will once again increase demand and lift prices. Now yes, lower interest rates does usually increase demand. However, if we were in a recessionary type environment, there's probably going to be a lot more economic pain affecting a lot more people. And for that reason, I don't think it's going to see the same demand that we previously saw. Also, in my opinion, gone are the days of super cheap debt. I don't see rates going back to zero at all. And the reason for this is the massive consequences that are playing out now with high inflation and soaring costs of living. However, anything's possible, and we need to consider all the scenarios. What do you think? Do you think I've built a strong enough case to show that housing's the next market that's going to fall significantly or even crash? Whether you do or you don't, I'd love to hear your thoughts in the comments below. I'm here to learn just like you, and together we can navigate our way through this extremely volatile period for the entire global economy. Hey, if you've made it this far, please subscribe to my channel. You definitely maybe won't regret it. I'm Biko Konstantinos, and I'll catch you in my next video.